Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. I've got some questions that are behind me. I'm going to use TradingView, go over some technical charts, do some technical analysis to answer a couple of questions that I received in the YouTube comments, which I do answer those every once in a while with videos. And it deals with silver, a couple of my opinions, and I might veer off a little bit from the question with some other pertinent information of how I view the markets. So let's dive into this. Let's dive into this question. It's about silver, and I'll just go through and run through my opinions on silver in its entirety. So you'll probably learn something, I think, from this, at least from my opinions on how I view this market and how I view the precious metals and when they work. I do a lot of this training. I call this training, or I call this sharing my opinions on the website as well. So if you guys like this type of analysis, I do this across the board of all these different sectors. And then I dive deeper into the companies, looking for specific traits that I look for in the companies. And it deals with the technicals and the fundamentals, and I marry them together. And I call myself a hybrid investor. It doesn't mean that I take the hybrid approach on every position. There are some ones where I may take a little bit more risk with less money, a little bit less position size, take on a little bit more risk, and try to swing for the fence every once in a while. And sometimes I strike out doing that, and I lose or reduce a small position size in the portfolio. But there are certain traits that I look for that I overweight, and there are traits that I look for that I underweight or put smaller position size in, perhaps. But let's dive in here. Let's take a look at these questions. I'll try to answer it with my opinions here. And again, if you like this type of analysis, you can check out finding-value.com, where I dive deeper into how to play these trends with individual companies, dividend-paying companies as well, and a whole bunch of different sectors that I think are coming into favor in the commodity space and precious metal space. So, and just a reminder, we do have a discount coupon code Mayday, one word, if you are interested. The description link below, you can look for those details. So this is the question. He says, I do have two burning questions I would really appreciate some answers to. And I don't really have answers. I've got opinions here. It says, what is your initial price target for silver before we see any significant correction happen? For instance, I'm expecting $50 to $80 silver before we have a major market crash, after which silver will then go on to even higher values like $300 to $1,000 over the course of 10 years. And number two, do you see silver having a major correction when the stock market rolls over? If so, by what degree and for how long? In 2008, it had a 60% decline, but perhaps there will be less of a liquidity crisis when the bubble pops. So I can give my opinions here. I mean, obviously, I don't know exactly what's going to play out in terms of where silver will exactly go and a time frame. I will say almost every prediction that someone tries to make with price and time, they will 100% get it wrong. If they get it right, it's most likely just by sheer luck. So I don't necessarily look at the markets through the lens that you're asking through the lens that you're asking these questions from. What I do is different than what you're asking me. So I'm going to describe what I do instead of answering exactly the questions that you are asking. So this is kind of what I do and how I approach it. So I've got the silver chart that's behind me. Let me just put the watermark back so you guys can see it's silver. So this is silver. I'm viewing this from a logarithmic standpoint on a long-term price chart. And then I put the size of a potential head and shoulders, or I mean a cup and handle pattern. A cup and handle pattern is this pattern here. That's the cup and that's the handle. You can also draw the handle a little bit different. You can draw a handle that goes through it that way, which is just a big flag pattern. And then this is a cup. And what this deals with, technical analysis deals with the herd mentality. So basically, what you're charting is the psychology of the herd that is creating this. It is the interaction of all the people in the markets and the psychology of what they think about the markets. So I also look for what I call confluence. Confluence is I'm looking for other pieces of information that either support or negate silver going up. And what I've found, and I could go through like 50 different charts, I can't really find much that negates the price of the silver move. Um, a lot of people ask me about a recession. They ask me about retracements. They ask me about how far could something go down in a correction. I don't necessarily focus on that much. What I look for is when does silver go up and when does silver go down? And what conditions basically allow silver to go up and down in? So when is it in favor and when is it out of favor? And I don't concern myself too much with price targets necessarily. I look at the size of the pattern and then I size different sectors against each other to say, well, what could potentially give me the best risk reward of all of the sectors? I pare it down to maybe 6 different sectors, 7 different sectors, or it depends on the sector and the equities in that sector and the risk reward of the equities as well. If I'm going to start to play the equities, and the equities are the stocks and companies of a commodity sector. There are some sectors that are more risky than other sectors. And that risk is dependent on the companies and if they are producers, developers, or juniors of those sectors. And depending on the risk will determine my portfolio position size. So when I look at silver, this is the big long-term picture. A lot of us joke, we call it the big long. That's what commodities are and precious metals at this point. It's the big long. And the big long includes the silver squeeze that I like to talk about. And we've been waiting for this potential break here of this trend line, this trend line that I've got drawn in right here. We've been waiting for that breakout to, I think, initiate a move on multiple time frames. So this here's the short-term time frame. We also have a pretty good resistance support level that goes across here. We can see that by all of the trading that occurred through history hitting those lines. So the more the stock trades at a particular price and volume is traded there, that is what determines your resistance and support levels. So we look at silver, we've had a really strong resistance support level at this area that I've got. Let me zoom it out like this. At this area that we've got going across here at 1865. So there's really strong support there for a long period of time. And I purchased a lot. I'm a long-term silver holder. There's this big double bottom there. I bought the crap out of it in 2018 is when I really loaded up. Not so much over here, but I did over on this right-hand side. I was going to buy it down here, but the premiums shot up quite substantially. So I actually selected platinum down in the 2020 crisis. We've come on up. I was buying a lot of silver in this entire region up here from somebody that was basically offloading it because they wanted to get out of silver. So I was buying it at spot price. I was waiting, or we were waiting, depending on how you want to look at this, for this to break to the upside. I've made multiple comments about this being an incredible opportunity because of the size of this pattern that we've got in front of us. So yeah, we've got resistance or support there. We don't really talk about that much. Then we look at resistance as we go up. And we can look at resistance on different time frames. Right now, I'm on a monthly candlestick time frame. And one of the strong support resistance levels we basically just were flirting with, it goes right across here. It's the $28, $29 region here. We hit it a lot in this general area here, and then we hit it a lot in here too. And we failed to break out here, and then we came back and circled back around. So there's strong support resistance at that level that we're at in about 28, 28.50 in that general area. So if we do get a pullback, I think the 28.50 level is a strong level that will act as support. So as we go forward, we can start looking at this chart from multiple time frames. We can do, 3 months. This is a 3-month candlestick. It looks like to me that we could come lower here, and then the 3-month, we still have that 29-ish dollar, 28 $28.50, $29 range that is really strong. So it's strong on the monthly candlesticks. It's strong on the 3-month candlesticks. Then we can go on the 6-month candlesticks and continue to adjust our candlesticks. Here again, you can see we've got really, really strong resistance support at like 28.50. So 28.50 is a critical level in my opinion. And then we can also go to yearly candlesticks. And I would say that's just a little bit higher here. And that level, I would say a critical level is about $31. $31 on a monthly close basis. And we're peaking out. We're at 32.16 as I'm recording this on May 28th, 2024. So if you were to boil this down to where are the big resistance levels and support levels, I would undoubtedly say that $28.50, $29 is a comfortable support range for silver. And that's kind of where I would say the majority of that support is at. And you can see that we're starting to kind of come above that. I think we're also going to get a little bit of resistance as we come up in this range here in the $40 to $50 range. We could also see some resistance there. And I think if we get up there, I think we're going to blow through it. So we're going to pause there, but I think we'll blow through it eventually. So we'll probably do something like that. We'll either go sideways underneath it or loop back around and create like another cup and handle pattern. Something like that. We could pull back. It's possible that the last cup here could do something like this would be a cup, and then we would pull back to 29 again or 28.50 for that handle, right at that support level going across. So that could occur like that. That is me just taking a guess. Now, if we break the $50 level, that's when things get crazy. There's no resistances above 50 really. So how do you guess? What do you do? You can do Fibonacci extensions. You can do those types of things based off of the patterns that are created. One of the things that you could do is you could say that this here is a flag pattern, and your flag pattern is basically that, and the run-up is this. So we could say that the potential move of the flag pattern, if we were to put that on there, you could say that we could get to $300 off that flag pattern on a logarithmic scale, maybe, and maybe that's the projected move. And then you could say, okay, well, maybe we could do a fib extension and stuff like that. But I don't know if all of that is necessary. What I kind of do, and I don't focus necessarily on the fib extensions and what could be a potential pullback and where it could go and when. I kind of just say, how big is this pattern? The pattern here, if you were to use this on a monthly candlestick, This is this that I put up there, and I got a price chart of like $500 an ounce. I don't know if it's going to go there, but it gives you an idea of how big the pattern is. And you can compare like the size of the patterns to each other. And then what I do is I say, okay, when does silver do very well? One of the things that I share on the daily updates is this TYX TNX pattern here. So what I'm measuring here is the 30-year divided by the 10-year. And then I can put gold underneath it, and I put gold underneath it, and you can see the buy points are these orange. You could buy here, you could buy another low point here. And then when this goes up, it generally, gold goes up with it. So think of it as the market uninverting the yield curve. It's like the correct market conditions for gold to do well under. And silver, I can put silver underneath it here. And silver basically follows that same path, just delayed a little bit behind it. It's the same path, and we're going up here again. And you can see we go from basically when the yield curve stops uninverting, you get your buy point for gold right at these bottoms here. So your buy points, even for silver, you could say these are really good buy points for the patient investor, and you could wait for this to kind of uninvert. I think that we could get something very similar to this to come up. So I think we're going to uninvert and then reinvert and then come back up again, which is a possibility. I'm not saying it is 100% the likelihood. Um, what's going to happen is the yield curve is going to remain inverted. We could see a slowdown in the system. The yield curve uninverts, and that is when gold and silver rocket. Gold and silver, they front run that uninversion. And that uninversion of the yield curve when they lower rates usually ends up in another cycle of money printing. So we're actually in the sweet spot for gold and silver to appreciate under. And when the yield curve uninverts, when things start to slow down and unemployment goes up and all of those measurements, that is exactly when gold and silver go up under. Now, if we start to uninvert and there is a slowdown in the market, like we got in 2007 and 8, and also in 2001, those two market pullbacks were not the same. In 2000, you can see here that was the tech bubble here, and the yield curve started to uninvert in 2000, 2001. That's when the slowdown occurred, and then they lowered interest rates. You can see that gold was starting to come on up during that, and silver kind of just went sideways under that condition. We didn't really see a huge pullback under those conditions. And we can zoom in on that. I'll zoom in on that. So 2000, 2001, we can focus on silver and go into that time frame. So in 2000, 2001, you can see we did have a pullback from like $5 down to 4. So about a 25% pullback. And then we rocketed higher here through that. And I think something like that, I think, has already occurred. And that's where things get difficult because they're spending so much money from a fiscal standpoint, fiscal spending and the interest rates. It's very stimulative. And then I also think Powell, we're in a presidential election cycle. There's all these things going on, and it's like everything leads to money printing. So, think of it this way, and this is the way that I think of it, and it could be wrong, but I think that what we're doing is right here, and we could get a couple of pullbacks like this as it goes on up. Here's your pullback in 08, 09, and then the eventual move higher. I think that we're like something like this here in 2002 and 3. So we're kind of coming up to that, and we're starting to break out. And what the market is doing is it's looking for a pullback in yield. So if I were to take this pattern here, what I'm going to do is I'm going to take this pattern here, which is that pattern there, right? And I'm going to try to overlay it to see how this basically aligns here. And I haven't done this yet, so um, let me just kind of zoom this in. So the pattern here, and I know you guys are going to be like, what does this mean? So what I'm looking for, and it's not going to be perfect, is this here, this section there is this section there. This section that comes up and squiggles is this section here that squiggles down. This one went down, but this one went upward. So the last little section there is this section here. It's all kind of squeezed together, hard to see. So, um, and I don't want to like, this is what this is. It's the lead-in pattern, the fractal that I'm creating here. It's the same movement up and down because what we're charting here is the psychology of the herd. And what I'm doing is I'm cheating because the psychology of the herd here I'm just going to focus on this. So this little section there is that, and this section here is up there. I'm just blowing it up, and it can stretch and pull based off the conditions that is created. So that this little section, I'm just cutting, just focus on this portion here. That is that fractal there. And we've broken on out, and we're like over here. We're probably going to see a big run, in my opinion, because of where we're at in the cycle. It has nothing to do with necessarily the sector itself. In my opinion, it deals with where we're at in the cycle. And then as long as we get those conditions that are continuing to push us forward, that is where I'm going to stay long. So if I were to do TYX divided by TNX, and then I were to put silver underneath, and what we were looking at was this cycle from here forward. So we were looking at the slowdown occurred here. So we're kind of looking at like the bottom here to here, and then this is what occurred there. And that's where it finally ended up at a top. So that is what I look for. It's not a price mechanism. I don't look at the fractal and try to project pricing. I look at the market conditions and say, this market condition's done here. It's all the way up here and it's starting to roll over. So more than likely silver will probably roll over and start going down. Now, would I hit the ultimate top of this? Maybe, maybe not. I don't know. But even if I capture, the move from, down here to up here, I'm okay with that. That's what I want to. I want to capture the majority of the move. That's my goal. No one's going to be perfect, and no one should expect that everyone else to be perfect. But we just broke out of a very long like consolidation underneath this. We have a long way to go to the upside, in my opinion, for silver. And all of the market conditions are still at our back for that to occur under. That's also when commodities in general really started to fly. Is when we went through a slowdown and then they lowered rates, and then commodities from about 2002, 2001, like in this general area, they just started flying all the way till 2008 when the yield curve uninverted, and the real estate market is what brought the whole thing down. So it, when I talk about all this, it's less about making guesses. It's more about looking and tracking cycles. That's really what it is. And I teach all this on the website. The guys guys and girls on the website, I go over all this and I go over exactly what I track and how I'm doing it. And I think that provides the confidence for the people to take positions and hold on. And that's what this game's about. It's about kind of knowing when things work and when they don't work. Uh, I see a lot of people focus on price and the movements to see like what the potential return is. I don't necessarily focus on just that. I use the fractal sizings to determine what could go up a lot. But if you look at history and you do Fibonacci extensions, a lot of the times they don't perfectly go to certain levels, and sometimes they blow way past it. And that is determined by the market conditions and how, I'll say, bulled up the participants get in certain sectors. So not all fractals will, in the fractal sizing, not all first waves or whatever will accurately predict the size of the third wave in Elliott wave analysis. So it's more about looking at what are the potential investments, what's the risk reward, and how big can this thing go to the upside in general, like generalities. Do we have the market genetics and the structure in the charts and technicals to provide the really big move that people want? And then what sectors have those charts to provide the big moves in the future, and how can we position in specific companies with incredibly good risk reward characteristics to take advantage of the sector strength. I mean, that's all what investing's about. So I can sit here and tell you silver, it's got projected moves between $300 and $500 an ounce. If you take silver and take it off logarithmic, which a lot of people would disagree on long-term charting, so I'm not on logarithmic here, then your fractal size, if it's like this size here, and I were to put it up, you're going to get a different projection. You'll get something like $80, $84 if you take that fractal size. But I think it highly depends on the conditions that the market is subjected to and how panicked people get in a particular scenario. If there is a supply shortage of silver where people find out this paper game, like on a big, massive scale, you could see people panic. And I'm not talking about like individuals, I'm talking about like industry. And it's like, what if industry starts to panic? And, is the price going to go to $50 an ounce? No way. It's going to go way past that. Because what's going to happen is industry needs silver to run their manufacturing facilities. If they start to panic, I mean, you might start seeing industry players just start buying mines. And then it's like, well, okay, well, where's this stuff going to come from? And then you're going to get all the silver squeeze people. They're all going to jump on it. So you got all these individuals trying to buy the physical metal. You got industry trying to, buy the physical metal. You got all these people trying to buy the physical metal. And then, I mean, on top of this, and I don't know what the outcome will be, guys. I'm just giving you a scenario. But what if the banks are trying to buy it too because they did all this rehypothecation, they did all this like loaning and leasing of metals, and they've got multiple claims against the physical, so they're trying to buy metals too, and it's like, what kind of scenario does that look like? I mean, I don't know, and obviously, people on the website, I've told you guys this multiple times. I prefer the physical metal because at the end, everyone's going to want the physical metal. They don't want an ETF. They don't want paper contracts. They don't want all that stuff. They're going to want the physical thing. So that's the way that I view it. Maybe I'm wrong. Maybe none of this, basically plays out the way that I think it could play out. But I, what I do is I position in a bunch of these different sectors for the possibility and the probability of these things occurring. I mean, uranium is very short on the physical thing. So I think there's going to be a squeeze there. I want some allocation to uranium. I think it could happen to silver. I think it could definitely happen to platinum. And with where I could buy those things, given the ratios, they're off the page cheap. So I can take a good chunk of my money, put it in like a physical metal that's very low risk in terms of there's no management risk, there's no country risk. You can go all the way down the line. And I can do it at an historical anomaly on the cheap side for most of these metals. I'm like, that just seems like a really good idea to do. And then I look at the upside and I'm like, these charts are huge. So why wouldn't I scale a good chunk into this where I can take a physical approach with what I think is the least risk approach in the market of any investment. I think gold and silver are less risky than bonds. I think it's less risky than a whole bunch of things in the market. I think it's probably the least risky thing to invest in. And you're telling me that I can do it at a time where the pricing in relationship to history is the cheapest it's ever been when I was purchasing it throughout, the last decade. Of course I'm gonna play this. And I play, the ratio game too on top of it, where I swap between metals during different market conditions. And if you guys want to learn that, bring it up during the question and answer session. I've taught it a couple of times, but I can keep going through it so you guys can see what I mean by it. And I'll give you an example here. I just did it. Here is platinum versus palladium, and I was a big palladium holder when palladium was cheap, which was up here. So this is platinum versus palladium. Palladium was cheap against all of the other metals, and I was purchasing in these areas up here, 2005 and 2009 in particular. Looked it all the way down. And again, guys, I didn't know as much as I know now about these areas. I just knew it was cheap. Nobody was really buying it, and I wanted exposure to it, so I diversified into it. I was also, I also owned silver during that time frame and gold. But I wrote it all the way down, and then I started looking at ratios and depth throughout this time frame. And I adopted the strategies, and in 2020, I swapped all my palladium for platinum in April of 2020 specifically because the ratio was ridiculous. I bought this stuff when the ratio was like one platinum ounce could buy over 5 ounces of palladium. I swapped my palladium and almost got 3 ounces of platinum. Now I'm riding this ratio back up. I'm already up quite a bit. As you can see, the ratio is 1.1, and I'm riding it from 0.35. So I've already increased my physical holdings here, and I'm going to ride it all the way up. And why did I choose platinum? What was the big deal here? I chose it because it was cheap against all the metals. And I can show you here real quick. So the platinum palladium, it was super cheap down here. And then you can see it was super cheap during this time frame too. Huge move up. It was cheap here, but it was also cheap against gold, where I had a really good, it's right here, really good entry point there. I swapped some of my gold to platinum at this ratio there, and you can see it did a double bottom here. And then I think we're going to break and move to the upside. Platinum does real well during these commodity bull markets. Last commodity bull market was from 98.99, like this section here, all the way up. And then it peaked in 2008. So, but on a ratio perspective, you might not be trading at 2008. You might be trading here to get into another metal. So platinum versus silver, it's also cheap against silver. Platinum is. So we had a real good entry point. This is 2020 here. It was cheap. And I think we're doing a double bottom here. It's probably going to bottom and then break out. But that's just a guess. I don't know for sure. But I do like silver and I do like platinum. And those are my two favorite metals. And then I also take investments with gold and silver mining companies, silver junior companies, and the platinum group metal companies too. So I'm positioned in everything kind of across the board, spread out. And I think those are some of the best opportunities that the market has to offer. And you can also look at something like the gold and silver mining companies in relationship to gold. And you can see that we are at historically low levels. Last bull market occurred, you could say occurred somewhere from this range, and it went all the way down to 2011. Gold and silver mining companies underperformed gold itself during that last bull market. I think that we could be in for something that is completely different that people are not ready for. And we are breaking the downtrend line to the upside now. So now is the time to be looking at technical analysis of the gold and silver mining companies to see which ones are bottoming to go on up. And the conditions that I just went over earlier are ripe for gold and silver to go up in. And we're breaking the XAU to gold ratio, which means that gold and silver mining companies could outperform gold itself. which we did not see during last bull market from 2000 to 2011. We did not see the same conditions. The conditions here are different. And you need to change, in my opinion, as an investor, you need to change your mindset when you have data like this saying that it is different and it's more similar to the 1970s. So that's kind of how I view things. And what I think could potentially be coming is way different than what it was in 2000 to 2011. We were in a declining interest rate environment at that time. Now we're going into an increasing interest rate environment. These market conditions are not the same. And that is where the difference lies between my opinions and other people's opinions. So I'll just describe, show you real quick. This is what I mean by yields. This was an increasing interest rate environment in 1977, 1960s, 1940s, and 50s before it. It was one big increasing interest rate environment. Then we went into a large, this is a head and shoulders topping pattern. We went all the way back down this inverted shoulder, head, shoulder bottoming pattern from here to here. And we've moved upward and broken that downtrend line here. So now in the declining interest rate environment here, I think we've changed and we're going into an increasing interest rate environment. Why does that matter? It matters because your bond prices, which has a head and shoulders top, is now declining. It means money is rotating differently in your environment based off of the market conditions. So I think that bonds will sell off, and I don't think the money's going to go back into bonds anytime soon, maybe not even ever, in the size that we had in 2021, 2020. And it's going to rotate and try to find something else. What is that something else? If we have an increasing interest rate environment, generally speaking, stocks don't do very well under that environment. They go sideways or lower. So the money may not rotate as much into stocks either. And when it rotates, it's going to find commodities or precious metals or something else. We don't need, I'm not saying all money is going to rotate into it. I'm saying some of that money will rotate into it. And it's going to change the environment. And it's going to change people's opinions, and their paradigms will eventually shift. And more money is going to rotate over time. So that's what I think is coming. And I teach a lot of this, and I dive deeper into the data of a lot of these things in charts. There's a whole bunch of other things that are occurring underneath this than what I've just showed you. I mean, there's a lot. In individual sectors, there's a lot of things occurring. There's a lot of things occurring in the precious metal sectors. And how do you play this? What's the most leverage plays? What's the best risk reward? All of those things matter for your returns. They matter hugely. Some people say, well, I'll just go into an ETF. Okay. I'll show you one of the companies that I'm using this company over and over. It is one of my best performing companies. It's not the best. Well, it's the best from where I purchased it, but it's not the best performer since 2020. So this is SM Energy. I bought it right here in October of 2020, September, October of 2020. And if I were to use an ETF XOP, that's the difference in return when selecting the companies. Now, I don't select, all of my companies are not, this return. This is one of my better returns. I'm using SM because I've already shared this as a pick in November of 2020 to YouTube. And you can go back and look at my videos, and if you want to look and see, you can see other ones that I've picked as well that return very well. Some of them are over 10 times their money, and other ones aren't as good as those. So choosing individual companies versus an ETF, you can absolutely wax an ETF. And that's really where I focused a lot of my efforts, is how do I identify companies that can potentially return very large amounts. That is what I focused a lot of my efforts on over the years. And that's what I think I'm good at identifying as the big return potential returning companies across all these different sectors. And there's things that I do to identify that I'm not going to necessarily share on YouTube, but I'll share it with the members that are on the website. But that's what I've got, guys. That's what I'm going to say there. Hopefully, I covered it. Um, I don't know when we get above 50. I don't know where we're necessarily going to get a pullback. I could, you could do a fib extension. That's about really what most people would do. Sorry, I grabbed the one there. So here's silver. We could put, we could do a fib extension, and a lot of people think that this here for the K wave is the first one. You get the pullback there. So a lot of the times, if you were to look at these fib extensions, let's go logarithmic real quick here, and then reset. So the extensions would go up to $85 would be 1.618. 2.618 would be $132. And 3.618 is 175. So 175 is a potential. We've got 130 and potentially 85. Those three areas, I think, could be areas on a wave 3 move that we're doing right now where we'll end up and potentially pause at. We could pause at 1-2, which is about $56. Those are the areas. If I were to choose something based off Fibonacci extensions, I would choose those targets there for that. And would we see silver having a major correction when the stock market rolls over? I don't think we would see a correction, yes, if it rolls over, but I think it will be short-lived. I think it will be violent, and I think it will go back up substantially. Yes, if we get the housing market to continue to go up. So it would be a pullback like 2000, 2001 it would be my guess. So that's what I've got, guys. Those are my opinions there. I think that we could see probably most everything rally here across commodities, including silver and gold, platinum, etc., etc. So that's what I've got. Give me a thumb up for the content, subscribe to the channel, and we'll catch you guys later. Spotting value.